Good morning.
Hey, good morning. Hold on one second here, buddy. I'm trying to find our line. Oh, we did receivables already.
Oh, sorry, Bob. I think I think I had you on mute.
Okay, I got you.
Sorry.
Can you hear me now?
I can hear you. Yeah.
Okay. All right, Patrick, let me just get back here. Now the class is getting a little trickier when you've got the chapter on the accounts receivable.
Yeah, it's funny. I think like you were saying you enjoyed that. I think that was one of my favorite
On
uh
the bad debt expense and stuff.
yeah, chapters so far. Yeah.
Yeah. Okay. So are we taking an exam this weekend? Is that the idea here?
Yeah, it looks like on Saturday
Yeah.
or tomorrow.
Okay. And I guess I already have a review lecture available online, and I'll also post this one here. Hold on.
Okay.
And then we wanted to get the FSA done Monday, huh? Okay. Yeah, I guess we can just review, huh? Okay, let's see what we have here. Hold
It's kind of weird that sometimes we'll have 12 people and then other times
on. Look at the
it's
crowd we're drawing here, Mary Ellen. It's me and Patrick. Oh, boy. All right. All right, Patrick, you get special education here, I guess. Okay. Let's take a deep breath.
All
All
right.
right, let's go through the chapters a little bit. How's that sound?
Yeah. Yeah, I mean, I always look like for, any 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 tidbits or clues that will help
Yeah.
me get through.
Come on, come on. Oh, hi, here we go. Hi, Bella.
Hi.
Hi, Lydia.
Hello.
All right. Okay. We have a big test coming up due Sunday, I guess at midnight, huh? Um, I don't know when Cornelia is going to open the test. She may do that maybe tomorrow, and you'll have a little extra time. I'll check with her on that. So I thought we'd just have a review session here, huh? And let me point out a few things. Okay. The chapter one was pretty perfunctory. It talked about the purpose of accounting. It's the language of business. We kind of know that. Um, the users, there might be, I'm sure there'll be a question or two on who uses this information. Who uses it? External people like banks and auditors and shareholders, and internal users like crazy. Internal users, purchasing people need to know how the business is doing in their area, etc. Opportunities in accounting, I don't think we're gonna worry about that. Ethics, ethics. I don't know if there'll be any questions about ethics, but not a bad idea to talk about it again. Um, One consideration is consider when you're doing a transaction, consider the consequences, huh? If you see this is going to possibly hurt somebody, step back and think about it. This, I think, they might mention on the exam, huh? The fraud triangle. You're under financial pressure, like everybody is, and you have an opportunity to steal. Your boss said you're in charge of the computer system and the accounting system. Well, that gave you an opportunity, and then you can rationalize it. Well, it's only X amount of dollars. Sarbanes-Oxley. I would hope they mention this on the exam. Maybe, maybe not. Sarbanes-Oxley. This was the law put into place about 25 years ago in the fallout from Enron Corporation, and it strengthens internal controls and forces management to be more responsible for their statements. So now you can go after the president of the company if bad statements get out. He used to be able to say, "Hey, I'm only the president. I don't know. That's Johnson over there in accounting who screwed up." Those days are over. Dodd-Frank, Wall Street. I don't know if this will be on there. Clawback. Clawback. People who honestly invested in something illegal, wasn't their fault. They may have to pay back what they earned beyond their original investment. And whistleblowers, squealers, right? GAAP, generally accepted accounting principles. We know what that means. They make up all the rules for how transactions are recorded and statements prepared. We don't do anything with the international. And they talk about general principles and specific principles. I would just run through this a little bit. A little bit. So they're self-explanatory when you see them. Measurement principle means that you can actually put a dollar value. Revenue recognition means revenues are recorded when the sale is made, not necessarily with the cash. Expense, the same thing. So I would just kind of look this over a little bit. Going concern, going concern. We assume the business is going to keep going, blah, blah, blah. You should pray they put this on the test, huh? Difference between a partnership, corporation, sole proprietorship. The key thing is the sole proprietorship and partnership, they have the personal responsibility. If you start a business with $1,000 and somehow manage to lose 1 million, you're on the hook personally for $1 million, okay? Cost benefit. Materiality is one that comes up a lot. Materiality. It just means, is it important enough to fix? A big company issues statements to the world, millions of dollars. Bottom line, they made a profit of $800 million. And then after that, someone runs out, we failed to count $100,000 worth of inventory at our Nebraska facility. It's such a small number, 100,000 in that environment. You just ignore it. It's immaterial. Accounting equation, we know what that is. Analyze, and then we went through a whole bunch of transactions where we used words like up and down, plus minus, and it just got us used to the accounting equation. And I'm going to skip ahead here until we get to some expenses. Oh, it's no expenses yet, huh? There we go, expenses. There we go. What I want to emphasize here, and you should know this already, equity, assets equal liabilities plus equity, the original investment by the owner, plus the profit. All revenues increase equity, all expenses decrease equity, okay? At the end of the month, we're going to take our net profit and move it over to equity. So I'm not going to go through this really. This is just to get you familiar with the accounting equation. And here it is here. You have common stock, revenue, expenses. Right now, this company has a $4,400 profit, which at month end, we're going to close into retained earnings, another component. And yeah, I'm just seeing if they have a metric for us to look at. Payment of a dividend, huh? It's like a drawing in a way. A dividend is not an expense. Sometimes students get confused with that. And here we go. Now we're looking at our general ledger, and there's the balances on the bottom, right? I said there's the balances on the bottom. Is there any confusion in the order of the statements? You must do the income statement first, then the retained earnings, then the balance sheet. Going through all this basic information. Doesn't hurt to look here. Here is our income statement, revenues minus expenses, 4,400. Our beginning retained earnings was zero because it was a new company. We add the net income and we subtract the dividends. That gives us the new retained earnings number, which we now bring down to equity. Okay, so you've had a lot of practice in that. Statement of cash flows, I'm not going to worry about this yet. Here's a metric, a measurement. Net income divided by total assets is called the ROA. The ROA. If you're ever flipping the channels and you come to the business news, you might hear them say Microsoft announced earnings of so and so with an ROA of whatever, 19%. It means that they have earned $19 for every $100 invested in assets. Okay. And I think that takes us to the end of this guide. So I'm going to close this. Anybody have any questions on that first chapter? Or okay, it's hold on. Just need to dig up chapter 2, huh?
I'm sorry I missed that. It's on like chapter 1.
Yeah, we're just getting into chapter 2 now. Chapter 2, there's the slide. Come on. Okay. Chapter 2. They talk about source documents. We know there's always going to be some paper involved. Source documents provide objective proof to a transaction. Going to get filed away. What are source documents? And here we introduce you to the general ledger a little bit, huh? An account. Cash is an account. Accounts receivable, blah, blah, blah. All those accounts that are in your chart of accounts make up your general ledger. General. And they're showing you have assets, liabilities, equity. You also have revenue and expenses. We know what assets are. We know that liabilities are bills that are due. We know that liabilities are IOUs. Look at your equity components, please. Common stock or an investment by the owner grows with revenues, decreases with expenses. In other words, the net profit. And maybe they give away part of the business to somebody in the form of a dividend, huh? The chart of accounts, this I don't think is going to be any problem for us. It goes in order of assets, liabilities, equity, revenues, expenses. We know that, I think. Debits and credits, left and right. That's all it means. And I can't help you with this. Can't help you with this. You just have to know the rules of the debits and credits. Assets have a normal debit balance. By normal balance, we mean the side of the T count, left or right, that increases the amount. Assets have a normal debit balance. You should never see a credit balance for cash, for example. If you do, there's something wrong. And then we introduced you to journal entries, and I think you did quite a lot of this on homework, right? Debiting cash, crediting common stock, you bought supplies. And now they're introducing us to an actual general ledger. See, accounts are useful, but obviously the general ledger is what we're going to use. And let's look at it just briefly. You're going to have, perhaps at the top of the page, the year. I'm not too worried about that. On December 1st, we had $30,000 we brought in to start the company, and then we bought supplies. We spent money here, balance 5,700. Huh? I think we're good there. And here we're just going to look at one or two of these things. Here in chapter 1, we introduce you to the accounting equation, and you plus cash, and you plus or increased common stock. Here, we showed you the way it's really done in the real world. You're going to prepare what's called a journal entry. You're going to debit cash, indent here, indent important on the credit, 30,000 credit, and look at our general ledger. Cash went up, common stock went up. So I don't think you have trouble posting to the ledger. So I'm going to keep going. If you want me to stop anywhere, just bellow my name. Payment of it. Wow, look at the cash now, huh? A lot of activity. They're down to 2,300, it looks like. And here we go. We've recorded transactions, and now we run our, we look at our general ledger, and that gets us going to prepare an important worksheet called the trial balance. Trial balance. It's a list of everything in your chart of accounts, and it's going to tell you if it's a debit balance or a credit balance, and hopefully debits equal credits. And you will never have to worry about that, I don't think, in the real world. I guarantee that. Trial balance. It proves simply that debits equal credits. Well, we subsequently learned that by definition, this trial balance is incomplete and requires adjusting. But for now, we're going to see what's going on here. Searching for errors. Nah, we don't do that. Prepare your financial statements from the trial balance. Now, on the test, they like to throw in these labels. The balance sheet is a point in time. Balance sheet is a snapshot of how many assets you had at the 31st, liabilities and equity. So you have to say something like balance sheet as of June 30th or June 30th. Income statement, equity statement, it's a period of time. You say for the month of or something like that. We sure know, right, that the income statement goes first, followed by the equity statement, which we're going to call it the retained earnings statement here, the balance sheet, and the cash flows, which we're not going to go into great detail. Income statement, we get that net income, $33.95. $33.95. We bring it down here to the retained earnings statement. And we get the new retained earnings number, $31.95, which we then bring over to the balance sheet, okay? I'm not going to worry about presentation issues. Well, the debt ratio is not too hard. You divide liabilities by asset, and it's going to give you an inkling on how much you're financing, huh? So look at these companies here. Costco is 70%. Walmart's only 59%. So you can argue Walmart is minimizing their liabilities or controlling their assets a little better than Costco. But I'm sure Costco knows what it's doing, and it can carry 70 cents. So for every dollar of assets, Costco has 30 cents left over. Okay. Any questions on chapter 2? Going once, twice? Okay, let's get over to chapter 3. Chapter 3, come on. Ah, watch that up. Hold on, hold on. Okay. You can see it, Patrick?
Yes, I do.
Thank you. Okay. Here we talk about accrual accounting. What you are learning is accrual accounting, which is GAAP. All financial statements are based on accrual accounting, which means you record revenues and expenses at the time they occur. It has nothing to do necessarily with the payment of cash, okay? Accrual versus cash basis. We're not talking about that. Revenue recognition, we should know this. We record revenues when the sale takes place or the service is rendered. Same thing with expenses. You record expenses when they take place. You don't wait for a bill later on necessarily. And now we're getting into adjusting entries. Here, here we're starting to think now. This is a little more tricky, but I think we've gone through it in fairly good detail. You've got the video I did of this chapter available to you, but let's just talk about it. They talk about deferrals. Deferral. A deferral means the service was deferred till later. Money changed hands, but nobody's done anything yet, okay? Prepaid assets, remember? Prepaid insurance or rent or whatever is an asset. When you buy insurance, it's an asset. When you buy supplies, they're an asset until you use them. So here we bought $2,400 and it sits in an account called prepaid insurance. We now have to go into the future and record what? Insurance expense. This is a 24-month policy. It looks to me like it's $100 a month, right? $100 a month. So every month for the next 24 months, we debit insurance expense, we credit prepaid insurance, okay? Keep in mind on all adjusting entries, you're going to have an item from the income statement and an item from the balance sheet, okay? Our adjusting entries are primarily, with rare exceptions, a search for unrecorded expenses. Same thing with insurance. We bought an insurance policy. We paid 24, it's 100 a month each. Prepaids. And there's your adjusting entry. Supplies, the same thing. We bought supplies on hand at the end of the month. We had 9,720. We sent somebody out to count the supplies. It came to 8,670. The difference is what, 350 or whatever, 1050. The difference is 1050. We now recognize the usage of these supplies. Debit supplies expense, credit supplies, and gets us down to the proper balance. Adjusting entry. Depreciation. Straight line. What's useful life? What we think an asset will last. The time frame has to be reasonable, huh? Salvage value, what a fixed asset is worth when its life is over. And we have our little calculation for depreciation, straight line. What is significant about the salvage value? You don't depreciate the salvage value. So this asset costs us 26, but at the end of its useful life, we think we'll be able to get rid of it for $8,000. So we only have 18,000 to depreciate. And again, the journal entry is always the same amount. Debit depreciation expense, credit accumulated depreciation. Okay. And this is how it's going to look on your balance sheet. They might ask this: equipment, original cost, less depreciation, right there. 25-1. Okay. We talked about the expense side. We could have deferral of revenue, huh? Unearned revenue, cash received in advance of providing a product or service. You go to me, I'm a lawyer. I'm a hotshot lawyer here in Santa Barbara. And you tell me you want to handle your will. And I say, yeah, I'll take care of that, but you got to give me $5,000 right now before I even do anything. Well, when I get that $5,000, I debit cash and I credit an account called unearned revenue, which is a liability. And then during the first month or so, I do all the work for you. That now I can claim the revenue. Now I've got, in this case, 5,800 in consulting revenue to begin with, and I earned 250, and I reduced the unearned amount here, 3,000 by 250. Guess what? Unearned revenue and prepaid expenses are the same transaction. It depends what side you're on. Here, I debited cash and credited unearned revenue. Insurance, we'll say. You are the one who bought the policy from me. You are going to do the opposite. You're going to not credit. You're going to debit prepaid insurance and credit cash. So that might be a useful tip. Unearned revenue is the same thing as prepaid assets. Unearned revenue. Okay, deferrals, money changed hands. Nobody's earned it yet, right? Adjusting for accrued. Here, something has been done, but nothing's been recorded yet. So we have to accrue the expense. Accrue. Here is a classic accrual. Salaries and wages. Fast Forward pays its employees $70 a day or $350. Wednesday was the 31st. Well, you're not going to get paid for that week until when? Until maybe the middle of next month, maybe. But you worked the 29th, 30th, and 31st and earned $210. You earned this money in December. We have to record the expense there. We debit salaries expense. We credit salaries payable. Okay. We could have accrued revenues too. Accrued revenues. One example would be Fast Forward agrees to pay $2,700 for future services. We're going to debit accounts receivable. Let's skip this. This is not really an adjustment. That's just basic sale of revenue. Okay. Here we're accruing some. Again, I don't want to confuse us. Again, this is not really an adjusting entry. This screen may help you a little bit. Deferrals paid before. Deferrals, money's changed hands. What's been deferred is the expense or the revenue. Accruals, the payment is made well after the event happens. So explain and prepare an adjusted trial balance. Okay, here's the start of our 10-column worksheet. Here's our trial balance, and here's the adjusting entries. For example, we had, I'm looking for A. We had $100 debit to insurance expense and a $100 credit to insurance expense. So that $2,400 comes down to $23. We had 0 to begin with, and that goes up to $100. The worksheet's not hard. The hard part is right here. You get those 2 columns done, you're more than halfway there. And now they're looking at the worksheet again. And we're going to prepare. Here's our trial balance. And from that, we prepare the statements, huh? But let me skip that for now. Well, let's not skip it. I trust you can read those words there. So if you can't read it, I'll make it bigger. Here's our adjusted trial balance. We know that everything after dividends is your income statement. 7850 and 300. Revenues, expenses, they made a nice profit of 3785. Our beginning retained earnings is 0 because it's a new company. They now increase it by 3785. We subtract the dividends. There is our new balance of retained earnings, and we just bring that up here. Where did we get these numbers? We're copying everything except this one number here, retained earnings. I'm pretty sure you're good with that. Closing entries. Please don't get confused on closing entries. Closing entries, okay? We have to close the temporary accounts. Temporary accounts are income statement. Temporary accounts, revenues, and expenses. We have to zero out those revenues, zero out those expenses. That difference is our net profit, which we then move into the asset account, equity, in the form of retained earnings. Here you go. It couldn't be more clearly stated than right here. Close credit balances. How do we do it? Revenues have a normal credit balance, so we're going to debit all the revenue accounts. We're going to credit all the expense accounts that have a normal debit balance, moving it to income summary. After step 1 and 2, income summary equals the net profit. And then we just get rid of income summary and credit retained earnings. And also you close dividends directly to retained earnings. Some companies do that, some don't. Closing entries, maybe seeing it visually might help a little more. Look at our expenses. We had all these expenses, and now we're zeroing it out and debiting income summary. Here we had revenue balance of 7850. We credited it out, and we moved that over to here. 8150, 7850 plus 300. And that income summary now goes to retained earnings and closed dividends. Closing entries, understand why we do them. Because it's the mechanism to update equity. At the beginning of each month, our total expenses should show 0. We don't want to keep accumulating expense with a telephone bill. That's not going to help anybody. We want to clear it out every month, close it out. And the post-closing trial balance is just your balance sheet. No revenues and expenses. Say that to yourself. Post-closing trial balance, no revenues or expenses. I would imagine you'll get a couple of questions where they try to trick you with this. They'll give you 3 items. They'll say, which of these does not belong on the post-closing trial balance? They might say accumulated depreciation, accounts payable, retained earnings, or electricity expense. Whammo, you know what's the electricity expense? Steps in the accounting cycle. Classified balance sheet, we're just talking current assets and current liabilities. Current assets chewed up within a year, used within a year, or the operating cycle. We're saying a year. Long-term investments or longer. What's a long-term investment? A big machine we bought. We bought a building in Oregon or something. Or we bought stock in another company or bonds or something. Plant assets, also called fixed assets. Tangible, depreciable, long-term items. Intangibles, we'll get involved with this in future chapters. Intangible, long-term assets, you can't see them, they don't exist physically. We're talking about patents, copyrights, trademarks like the McDonald's logo. Current liabilities are those due within a year. Long-term, new. Equity, you could call it the owner's claim on the assets. Equity, it's what the company is worth on paper at that point in time. It may have nothing to do with the actual value of the company. Company could be worth a lot more than that to people. Now, we want to know this metric, right? Profit margin, net income margin. Net income divided by sales gives you your profit margin. And look at Visa and MasterCard, these crooks. Visa, 36%. When they divide their net income, 6699 by 18,358, they get 36%. Wow. What that means is for every dollar of sales, they retain 36 cents. That's a pretty darn good profit margin, huh? MasterCard's pretty darn good, too. It's interesting, though, to see the year before, MasterCard was only 2 points behind Visa, and that seems to have gapped out again. Net income divided by sales, huh? The current ratio, super important metric, super important. Current assets divided by current liabilities. Current assets minus current liabilities equals something called working capital. Now, you're trying to compare yourself to a competitor on the other side of the country. Your working capital is $100,000. His working capital is $1 million. Who's doing better? You can't tell just from the dollars. He might be a much bigger company than yours, and his 100,000 might be puny. The correct way to compare is via the current ratio. So look what we have here. 2 years ago, Costco, its current assets barely exceeded the current liabilities. What we're saying here is Costco, after paying off all of their debts, has 1 cent left over per dollar paid, okay? That's kind of a crummy number. You want to see like a 2 or a 3 there. And we did not go into the alternative for prepaids. Anybody have any questions, any thoughts on the world of adjusting entries? No? Okay, going once, going twice. Let's get out of here. And we're up to good old chapter 4, huh? We covered a lot in this class, didn't we? Chapter 4. Yeah, we're doing real world type things now. Chapter 3. Every company in the world has to deal with adjusting entries. There ain't no way about it. Let me set this thing up. Ah. Bella, do you see the slides?
I do.
Okay. You haven't been sleeping on me, have you, Bella?
No.
Okay, all right, just check. Okay, here we go. Accounting for merchandising operations. Merchandising, we buy and sell something, huh? Activities and income components. A service company provides just that, services, a plumber, an electrician, an accounting firm, an architect, a lawyer, right? Merchandising. Let's look at this here. Here is where we introduced the longer income statement. Before this chapter, we had it looking like this: revenues minus expenses equals net income. It was simple as that, right? We listed all the expenses, all the revenues. That was all. Here now we're talking about something called net sales. Net sales minus cost of goods sold equals gross profit. From the gross profit, we subtract operating expenses to get net income. This provides the reader of the financial statement with a good isolated look at what's probably by far the biggest expense: cost of goods sold. Let me again remind you, cost of goods sold is the amount of money we paid for the item we sold. Okay? For the item we sold. Here, we went out and sold $14,757 worth of garments. We paid $9,440 to bring those into our store. That's what cost of goods sold is, huh? Identify the cost flows, huh? Well, we kind of know this. It starts with you buy something, you sell it, you collect cash, and blah, blah. This is really super important to understand here. And we're going to be going, we went over this quite a lot. Inventory system. Beginning inventory plus purchases gives you available for sale. We had 200 books in our bookstore at the beginning of the month. We purchased another 800. That represents 1,000. We could not have possibly sold more than 1,000 books. So beginning inventory plus purchases is merchandise available for sale. Seems simple here, but you guys tend to get a little rattled by it when we go to the problems. Once we know what's available for sale, our job at the end of the month is determine how much of this cost is now to be passed along to people who bought our product. In other words, cost of goods sold, and how much remains in our ending inventory. And they talk about two systems, perpetual and periodic. And I kind of wish they had started us off with the periodic, but they did the perpetual first. So here we go. They bought $500 worth of merchandise. We're debiting merchandise inventory now, not purchases. None of you should have a problem with this now, huh? 210 net 30. You get a 2% discount if you pay within 10 days. Otherwise, you pay the net or total amount in 30. And we agree that a 2% 10 discount is equal to almost 37% per year. You'd be crazy not to take it. On the test, they sometimes like to throw that out. They'll say a 2% 10 net 30 discount is what rate annually? And they'll give you like 2%, 15%, 20%, and then that big number, which you know is the right answer. Credit terms, huh? Discount period. You pay within the discount period, you get that discount. You pay 98 instead of 100. There's an invoice. Wow. Z-Mart paid the amount due on time. They owed $500. So we cut a check and we settled $500 with only $490. That $10 under the perpetual, we're just going to credit it to the inventory. Here, they paid it outside the period. What happens if a customer pays you in 30 days instead of 10, but they take the discount? What do you do? Do you automatically call them up and say, hey, you guys took the discount. You owe me $10? Well, there's a little bit of politics there. What if it's a customer that's been buying millions of dollars from your company every month for the last few years, and they always pay on time? And this is just the one time they didn't. You are certainly not going to bother them for that. But you could put that $10 on their next bill or something. Purchase returns, purchase allowances. Most merchandising companies like Kmart or Nordstrom's or Target, they allow you to return merchandise under most conditions. Accounting-wise, we're going to call that a purchase return, or they give us a price reduction. Purchase allowance. Here, we got an allowance. We bought something, it was defective. We brought it to the attention of the store, and the store says, how about I refund $30 to you? And we say, that's good. So they give us a $30 allowance. They reduce accounts payable, and or they might have sent us cash. Z-Mart. So we have all these different purchases at different times. These are not hard entries. FOB. I hope they put FOB on the test, because I'm one of the few people who used to get in arguments with people over the FOB or destination item. Without getting into detail, FOB, freight on board, is the point in time where ownership goes from the seller to the buyer. If it's FOB, shipping point, and we're shipping something to a customer in New Jersey, if that truck turns right on Cliff Drive here and falls over and all the goods are destroyed, the buyer in New Jersey is responsible. If it's FOB destination and that truck overturns in Port Newark just before turning into the building, you're stuck, the seller. So FOB, when title changes. Here, purchase merchandise, FOB shipping point. Okay, big deal. So FOB shipping point means that the buyer owns it right away and thus has to pay the freight. That's all. Look at the itemized cost of merchandise. You pay Nordstrom's or the store, and you got a discount. You returned some goods, but then you had to pay somebody to move the product across the country. Net cost of purchases. Why are we showing you this? Because this is a little section of your bigger income statement. Okay. Gross profit. Net sales minus cost of goods sold. Gross profit, not net profit. This is the grossest profit. Sales of merchandise, huh? Sold it on credit, huh? Here we're looking at the same grid. We got the discount period. And now we're on the selling side. We're on the selling side. We sold something here for $1,000, 210 net 30. Wow. And here's our cost of goods sold, merchandise inventory. We recorded both the sale and the cost of goods sold. The guy paid us. He got rid of $1,000 debt by paying us only $980. Different sales discount. Sales discounts are contra revenue accounts. Contra revenue accounts. They reduce sales. You never debit sales. Never. Just like you never credit an expense. Okay. Here, I'm not sure we got to worry about this. Customer sold something for $15. It was returned to us, and it was a little defective, so we're going to bring it in at $9. I'm not going to worry about that. Hey, adjustments and closing entries, huh? For a merchandising outfit. Well, they're going to have the same adjustments we went over in the prior chapter. They're going to have shrinkage. Anybody of you who've seen Seinfeld knows about shrinkage, huh? Shrinkage. It means that the inventory disappeared. We went out to count the inventory at the end of the year, maybe, and our financial records, the general ledger, said we have $12,250. We only counted 12,000. We lost $250. That goes to cost of goods sold. Reduce the inventory, okay? And here are the journal entries. The closings, we just went over the closing entries. Look at them here. We debit sales to get it to zero. We debit all the expenses to get them to zero. But now we have another expense, cost of goods sold, and these contra accounts have to be closed as well. And then you close the income summary to retained earnings, okay? Multiple step, here you go, multiple step income statement. It just means we're going to have gross margin, okay? It means we're going to separate the non-operating activity from operating. It means we're going to have to compute the cost of goods sold, okay? Take a peek. Sales, we can call these gross sales. Gross sales, less sales discounts and allowances, get us down to net sales of 314,700 minus cost of goods sold, gross profit. Net sales minus cost of goods sold gives you gross profit. But we have to calculate the cost of goods sold. And remember our template, beginning inventory plus net purchases gives us what's available for sale. We count the inventory and subtract from what's available. And there we go. There's our cost of goods sold, okay? Cost of goods sold. So that one's a tricky part, huh? In fact, some of your income statements actually show this calculation. What do we subtract from gross profit? Operating expenses. Operating. Only those expenses that have to do with the core mission of the company, the operation. Coca-Cola, my favorite stock, bottles, produces, distributes, sells soda. When they collect money from a customer, operating. When they pay a vendor, operating. When they pay their employees, it's operating, right? We only want the operating expenses here because we want to present to the public something called, oh, so sorry, guys. Ay, ay, ay. We want to present income from operations. Here, we had other activity. We apparently loaned somebody money, or we put money in the bank, but that has nothing to do with the operation. We sold the building, and you have these different things. So an investor, a lender, looks at this and pretty much ignores this other stuff, at least at the beginning. And they say, okay, their income from operations is 12.9, 12 over 31. They're doing fairly well. You can make a decision or two. The income statement, that's the old-fashioned one. Balance sheet. Here's the classified one. Classified. What are we classifying? Current assets and current liabilities. Hello, another metric. We are experts in the current ratio, right? Current assets divided by current liabilities hopefully gives us a number more than 1. If the number's below 1, it technically means we're insolvent. It means we cannot pay all of our current liabilities at this point in time. That could be a red flag. That could be an indication of something wrong. Hopefully not. Hopefully companies know what they're doing with it. Let's make the test more stringent. We're just going to take the cash and receivables. And maybe if we have a stock or something, cash and receivables only, divided by the current liabilities. Here, the current for this company, Nike, the current ratio is 2.9. The asset test is 1.8. They are mighty liquid to me. Those are good to me. Those are good looking numbers. If this number was 5.9, it would be even better, huh? What if it was 35.9? Well, that's ridiculously good, but probably not good for the company because you're hoarding cash. If you got that much money available, get out and spend it. You got to spend money to make money, right? Open a new factory, a new store. The gross margin ratio couldn't be easier. I hate the presentation. I really do. Gross margin divided by net sales is all it is. Gross margin divided by net sales gives you a number, 44.6%. So the cost of buying our merchandise leaves us with only 55.4 cents. Yeah, here I'm going to have to ask you to do some studying on your own. I really don't know how heavy they're going to hit you with this on the test, but be aware we have 2 systems, right? The periodic system, the perpetual system. Under the perpetual system, your buys go to merchandise inventory, okay? If you get a discount, we're going to move it to merchandise inventory. If you get allowance, it goes to merchandise inventory, okay? That's the first thing. Under the periodic, we're calling them purchases. Under the periodic, we're calling them purchases. Purchases is a cost. Merchandise inventory is an asset. Under the perpetual, we record the cost of goods. Let me see if they have a sale here. I'm not going to worry about that. Okay. One difference between the two, where you see the word purchases on the periodic, it's merchandise inventory on the other side. Okay. Now, here's what I wanted to see. This is the key difference between the two. Under the periodic system, you debit accounts receivable and you credit sales when you sell something. No cost entry. Under perpetual, you got the same entry. Debit accounts receivable, credit sales for 1,000. But under the perpetual, you also record the charge to cost of goods sold and the related decrease in your inventory. Under the perpetual system, you always know how much you have in the inventory. Under the periodic system, you have no idea. You have no idea until the end of the month when you have to count the inventory and back into the number like we showed you earlier. And the journal entries. Okay. I don't think we went into this, nor do we need to. Okay. Who's got a question? Someone's got a question? No one's got a sports question? Nothing? Anybody watch Jeopardy tonight? I already know the answer to Final Jeopardy. I don't know if you guys watch Jeopardy, but I realized the New York Times, which I read every day, publishes the Final Jeopardy question. So I've been cheating like crazy with my sister here. I know what the answer is at the end. Anyway, I guess we're up to another chapter. Oop, I may have to, okay. I'm going to have to move locations, guys, because my machine is running out of juice. So if you just hold on a moment. Can I bother you? Running out of juice. I got to plug it in. Okay. Hold on. Okay. We should be all right now. Oh, I'm sorry. Sorry. It's come on, guys. Let's go here. Come on. You have to give me a moment here. This thing bombed out. I got to go back in here. Hold on. We're getting there.
To you by CarShield. CarShield, cars go farther. You've been paying attention. It's just about what you need to do your wallet. I'm calling you, but you still get last year's price. Right. One call to CarShield now. 22 prices. So you can have peace of mind knowing that you're not only protected from mechanical breakdowns, also from the rising rates.
Okay. Hey, Marcella, do you see the slides?
Yes.
Uh-huh. Okay.
Thank you.
All right. Now, what we did in the prior chapter, we looked at purchases and sales. Now we get into the world of inventories and cost of sales. This is the kind of stuff that I did for many years. Anyway, what makes up the merchandise inventory? It includes all the goods a company owns and holds for sale, huh? And you might have goods in transit you need to worry about. You got to know what's on consignment. That's an important consideration. And what to do about damaged goods or obsolete. Hey, back to freight on board. FOB shipping point. Buyer owns it right away. FOB destination. Seller owns it until it gets there. So in the first part here, the buyer is responsible for the freight, responsible for the insurance. We understand what a consignment is. Consignment is the movement of inventory to somebody else, but you retain ownership of it. My best example is when you walk into Macy's or these various department stores, you often see and smell the aroma of perfume that these ladies are schlepping behind the glass counters. That perfume is not owned by Macy's. It's owned by the perfume company. The deal is Chanel says to Macy's, here's 100 jugs of perfume. You pay me only when you sell them. So Macy's tries to sell the stuff. They sell it for $100, and then they notify the consignor and pay him $40, and everybody's happy. Damaged goods need to be recorded as obsolete. Okay, all expenditures regarding inventory cost. You're bringing in an inventory item if it requires shipping or storage or insurance, maybe import duties. If you have to knock a wall down in your factory or your store to get the stuff inside, all of that is part of the inventory cost, okay? And here they talk about internal controls where you take a physical inventory once a year. Not going to worry too much about that. Now, here we go. You got to know these 4 methods of measuring your inventory. What we're doing is we're going to look at the cost of goods available. Cost of goods available. It's the same for every method, right? We have a beginning inventory of $100,000. We brought in another $900,000. That adds up to $1 million available. And our job is to break that $1 million out between the cost of goods sold and the inventory using these 4 inventory methods, okay? So let's see what we're talking about. First in, first out. FIFO. FIFO. Here, it looks like we're selling just one item, okay? Here we go. On May 1st, we had, let's say, a beginning inventory of 45. Then we bought something on May 3rd for 65. And then a few days later, another one for 70. Then on May 10th, say, we sold one item. Which one did we sell? Under FIFO, we sold the oldest one first. That makes the cost of goods $45. LIFO, we are assuming, we're pretending that we sold the oldest one first. The oldest one is 70, more expensive. Cost of goods sold is 70. And then weighted average, we're just going to add these numbers up and divide by 3. 70 plus 65 plus 45 equals 180, $60 each. So that's a brief introduction to LIFO, FIFO. And again, I call attention to this. Beginning inventory plus purchases available for sale. You get the available for sale, now you're ready to roll. let me skip down here.
Bob, while you are scrolling, can I just like jump in with like a short question?
Absolutely. Talk to me.
Okay, so first of all, there's a question for you, if and for the students, if anyone has a question on the FSA1 at the end of this class, might be an opportunity to ask
Oh, I'll
Bob.
be glad. Yeah, I'll be glad to go over the FSA if you
or
want to.
or on Sunday in the tutoring. And also, I'm not sure if anyone here has tried to access the sample, the sample FSA that I put out. It's the one that's linked to the directions, because I just got one email from a student who said he can't open it, but it looks totally normal to me. Anyone here who says I clicked on the one where it says which is linked to the instructions?
It says this file is currently locked, but I'm not sure if I'm on like the wrong email.
Are you in the instructions for the
Yeah.
Bob, can you let me share my slides?
Yeah, are you looking?
Can you share my screen?
Yeah, sure. Hold on here. I was going to say, I could probably go in there and fix that right now. And who was talking? Oh, Cornelia, how you doing?
Yeah. No, it's just it looks normal to me. I can't understand that it said to me it's published. So can you let me share my screen? You have to enable screen sharing.
Yeah, hold
on. On my screen, it says there was a little pop-up window at the top that said that page had been disabled.
What the heck?
In my that's what it was telling me too.
All right. So sometimes I hate technology. So we are in the modules page. That was too much. So wait. Am I 7? Exam number 1, FSA 1. And then see example FSA 1 for 2023, right? And correct. that's the one that's not opening for you?
Yeah, we're not even allowed to download it.
Okay, I will just delink it, load it again, and try to. Oh, okay. All right.
Are bullet points okay?
What?
Are bullet points okay?
What bullet points?
That's in Cal. You can make some bullet points in Cal, but we do want to hear a little bit of a narrative too.
Yeah, and I really think it's important that you read this sample, because it gives the narrative. It's the expectations are described on the bottom. You guys need to have access to this. Let me work on that while you guys are continuing with your lecture.
Okay, so at the end of this class, will it be up there, Cornelia?
I'm fixing it in the next few minutes. So in case it's still not working, call me, Bob.
Okay, sounds great. I'm glad you stopped in.
Sorry about that, guys. Okay, keep on with your lecture.
Will do. Share the screen, huh? All right.
Monty says mostly bullet points, so I guess I'll work on a narrative after work.
Okay, well, I'll be able to help you guys with it. Okay. Hey, and Kelly, you see the screen, right?
I do. Thank you.
Okay. We talked about the different inventory methods here, and now we're going to go in with under the perpetual system. So let's take a look at this. Here we have a beginning inventory of 10 at 91, purchased 15 at 106, and they're coming up with 1590 total. If we added those two numbers together, you get, I guess, $2,500. That would be the available, right? That would be the available. They sold 20 units for $130. Okay. And then they purchased some goods here, purchased some more. So here we go. Your units available for sale, 55 units acquired at retail, 5,900. So this is just your history. This is just your beginning inventory plus your purchases to get your cost of goods available. They sold 20 units here and 23 units there. So let's see what we're going to do with this. The total cost of 55 units available for sale. On August 14, what are they doing here? 8 at 90, they sold 20. I don't like what I'm seeing here. They sold 10, they have 10 at 91, 15 at 106. They sold 20. And now we want to come up with the cost of goods sold here. 8 at 91, 12 at 106. What are you talking about? What are you trying to tell me? Oh, for heaven's sake, there it is right there. Sorry, guys. Under this method, believe me, it's not as hard as I'm making it right now. We have 25 units to account for, right? 10 plus 15, that's our available at that point. We sold 20. That means that we sold 8 at 91, 12 at 106, 8 at 91, 12. I really don't know where they're coming up with those units. 8. Good heavens, man. Think. You have 25 units available. We sold 20. To me, the right answer would have been under FIFO would have been 10 times 91, 10 times 106. And they're going 8 and 12. Oh, for heaven's sake, class, forgive me, please. Forgive me. I'm falling apart here. This is under the specific identification method. This is one of our 4 methods. It's the easiest of them all, believe it or not, because they're telling you exactly where the goods came from. In other words, you don't have to do any figuring at all. They tell you what happened. They say that 8 came from the first layer and 12 from the second. Specific ID. This is the inventory method that does reflect the actual movement of the goods. This is for big ticket items. This is for very expensive items. When I bought my Ford Edge about 10 years ago, I gave the guy my check and he said, "Thanks, Bob. It's a deal." He did not then tell me, go out to the parking lot where there are a dozen Ford Edges there and pick the one you want and just drive it off the lot. No, they have to know exactly which car I purchased. They need to know the VIN number, the engine block, all this information in case there's an accident or a recall. Specific ID. I don't like that they made that the first choice. Now let's do one where we do some ciphering. First in, first out. We sold the oldest stuff first. Okay. Now, if there's a God in heaven, it'll do what I tell you. Here we have a beginning balance, it looks like, of 10 and 15 were brought in, okay? So we have 25 of these, really. The question is, which ones did we sell? Under FIFO, you go to the highest level, okay? You go to your beginning balance, and that's first out. So we need 20. 10 came out at 91. 10 came out at 106. 10 at 91. 10 at 106. We had a beginning balance of 10 plus 91. And then we brought in some more. First in, first out. Last in, first out. Last in, first out. Here you go. Remember, we sold 20, but we're selling the last in first. We're pretending that we're selling this 15 times 106, and then we go higher up for 5 at 91. Okay? You do a few of these problems, I think it'll clear it up for you. I have a feeling that you're pretty good with this right now. You've already had a session on it. Did substantial homework if you kept up with it. Last in, first out. And then a super easy one, weighted average. Here's your simple formula. Goods available divided by units available. Goods available. Here we had 25 units available. They bought 10 and then they bought 5, 25. The total cost of all this stuff was 2,500. So the weighted average is 100. 100. 100 times 20 is going to be your cost of goods sold. Let me see if I can make this a little clearer as we go here. And they're just taking you through the perpetual. Under the perpetual system, please notice that every time there is a sale, we have to compute the cost of goods sold. So here we're just racking up purchases. Here we sold something and we have to figure out the cost of goods sold. On the periodic side, you only do this once a month at month end. Now, here's what I really like you to see. I would imagine there'll be some questions along these lines. There should be. There should be. Net income. Inventory methods always come up with different results. Look at FIFO. FIFO reported net income of 721. LIFO was only 609. Weighted average is kind of in between. Specific ID, that's in a world of its own. They're just telling you that this car was sold, this diamond, if it's a jeweler, etc. What do you notice about FIFO versus LIFO? FIFO will always give you a higher net income, assuming an environment of rising prices, which is what we teach here, which is what a normal economy works under. A little bit of inflation all the time. FIFO, 721, LIFO, 609. LIFO, they're only going to pay taxes on $609. FIFO is going to pay on 721. But FIFO doesn't care because the FIFO guy, maybe he wants to put his best foot forward and have a big headline. You know, Coca-Cola announces record earnings of $721 million. Weighted average, there you're being a coward. You're afraid to go with one of the methods, huh? If you use LIFO on your tax return, you got to use it for your general ledger. I don't think we need to worry about that one. This is an easy concept here that students tend to get rattled, huh? Your inventory is always recorded at historical cost. You bought a garment for $100 and you've been selling that garment for years and years at a higher price, you don't have to do anything. You never increase the price of an asset to match the market. But if the cost goes below the market, we've got to write an entry. So let's see what we have here. We have two things. We have a Roadster and a Sprint. Okay, it's a motorcycle company. So they had 20 of these that cost $8,500, right? The market is now only 7,000. We have to write an adjusting entry for that. We have to say to ourselves, 20 times the difference of 1,500 is going to result in a debit to cost of goods sold and a credit to inventory. We must select the lower of cost or market. It's called the lower of cost or market. The second item, we're okay. We paid $5,000 for an item that's selling for $6,000. The first one is no good. Our salesmen are coming back to us and they're saying nobody's buying this Roadster anymore for, say, $10,000. The cost is way off. The market is way below. We got to record that entry. Debit cost of goods sold, credit, merchandise inventory. Here, I think there's going to be a few questions on the test. The impact of inventory errors. We're talking about overcounting or undercounting the inventory. This is pretty simple. If you just take a few minutes, if you understate the inventory, you overstate the profit. If you overstate the inventory, this is not correct. Hold on again. This is not right. If you overstate the inventory, you will overstate. This is absolutely wrong here. I hang my hat on that. Well, let's take a look at it over here. Let's see what happens. Here we have an income statement for 2016, right? The correct inventory amount is $20,000. Let's agree on that. That's what they should have counted. They failed to count, it looks like, 4,000. They only counted 16,000. So they came up with net income of 26,000. But if they had counted things correctly, they would have come up with a higher profit of 30. Okay? If we change the 16 to 20, that's 60 minus 36. Let's see what happens here now. You go to the next year, you're stuck with that bad beginning inventory. You add your purchases and subtract out the ending. And here they're coming up with 56,000. 56,000. So the point to be made here is what error you made in year one, you're going to have the opposite error for the same amount in year two. We should have counted 20,000 each year in this example, and this should have been 30. This should have been 30. So we botched up 2 years. It doesn't correct itself until the third year. Okay? And I want to look at this thing here a little more. Okay. Effect of the inventory errors. I'm just getting used to these slides a little bit from the new McGraw Hill slides. They've supposedly improved them, but okay. Here they're saying it correctly. If you understate the inventory, you understate your assets and your equity and your net income. If you overstate, the opposite. Assess inventory management. Now here I sure hope they put this on the test, huh? This is super real world. Inventory turnover. Cost of goods sold divided by inventory. Cost of goods sold divided by the average inventory, averaging the beginning and ending, reveals how much is available. Tells you how much is available. Here they're giving you a little complicated thing, but let's look at it. Here we go. This is a better look. Cost of goods sold, 111,882, current year Costco. The average in the inventory was 98.34. When you divide that out, you get 11.9 turns. They're calling them times. They should be called turns. Times or terms, the same thing. But like I said, you go into a meeting and you start talking turnover, you're going to put people to sleep, because the turnover is kind of an eclectic measurement, okay? It doesn't translate itself easily into dollars or anything. So what you're going to do is take a year, 365 days divided by 11.9, 32 days. Now you have something everybody understands. This company takes 32 days from the time they buy the product until they ship it. Okay? It takes 32 days for this company to buy a product and sell it. 32 days, that seems pretty quick in my world, but who knows? Walmart takes longer. Costco has a faster turnover. That's interesting, huh? And it's not even close. I'm just going to go into this a little more, hoping they properly show the accounting methods in a much clearer form. Okay? Let's hope they do. Periodic. We're not worried about any of this until the end of the month. Okay? So we can ignore these sales until the end of the month. Under perpetual, remember, we were taking these 20 units and we got 10 of this one, 10 of that one. Here, we don't do anything till month end. So at the end of the month, the goods available are $59.90 for 55 units. Total of 55 units available for sale. They sold 8 bikes. They have to tell specific ID against get us screwed up. I'm sorry. I hate that specific ID. Here we go. FIFO. We're doing it all at the end of the period. Well, we had ending inventory of 12 left. 12 left. So that's a small number. That makes it a little bit easier to work with. And we were doing FIFO. So what's in the ending inventory? It would be these guys we never got to. 10 at 119, 2 at 115. 10 at 119, 2 at 115. LIFO, the old stuff is still in the inventory. So here, it's 10 at 91, 2 at 106. Hopefully this makes it a little bit clearer. We'll see. Weighted average, super easy. Take the goods available line and divide it out. 59.90 divided by 55 equals 108.91. We sold 55. There's your cost of goods sold. And we have 12 left in the inventory. 1307. And again, FIFO gives you the highest net income. LIFO the lowest. Weighted average somewhere between. And Specific ID can be all over the place. And that clears us up. Any questions on number 5, chapter 5? Going once, going twice. We stop the share. And I guess we've got one more to go. You guys hanging in there with me, huh? Modules. Modules. Okay, this is the last chapter we need to review, huh? Okay. Oh, this was kind of a dull one, wasn't it? You go. Lydiana, do you see the slides?
Yes, sir.
All right, you're waiting for me to ask that question. I'm trying to find somebody snoring. No, I shouldn't say that. Slideshow custom. Here we go. Hey, cash fraud and internal control. Internal control. These are the policies a company has in place, rules to protect its assets. Here's Sarbanes-Oxley again. Remember that. I don't know what this is. Committee of Sponsoring Organizations. Yeah, when you're doing internal controls, you want to look at your environment, but you also have a risk assessment. Okay. You have millions of dollars in cash. I'm exaggerating, but you have business that brings in millions of dollars of cash every day. Man, you are going to have a great deal of risk. You don't want to have that stuff stolen. So you're going to have the money come to you and put right into a safe, and that safe is locked. You might even have a security guard there or a moonlighting cop. It's a lot of money. Petty cash, you're not going to go through the same thing for $200. It's sufficient just to lock it up in a drawer. So you always got to consider the risk. Basics of internal control. You set up responsibilities. This is your job. Do it. This is your job. And you want to separate the jobs. Establish responsibilities. Keep good records, right? We know that. Insure assets. You should do that, I guess, right? You have $1 million worth of inventory that might be seasonal and the weather's bad and destroys it. Well, hopefully you're insured. Bond key employees. You're hiring me to handle all those millions of dollars of cash. You call up an insurance company and you ask them to insure me. And they go out and they check me out and they say, yeah, Bob's okay. We think he's all right. And they'll issue an insurance policy in case I steal something. This is super important. Separating the tasks. You don't want the same person opening the mail. We're talking about cash now. You don't want the same person opening the mail who then writes out the deposit slip, who then goes to the bank and then enters it into the general journal. You want to separate those things. If you separate the responsibilities, it's going to take a lot more to rob the company. Technological changes, huh? Let's see here. Limitations of internal control. Human error. People make mistakes. No internal system is going to help you with that. And human fraud. Even though you have good procedures in place, people are going to figure out ways maybe to get around them, and you're always fighting that. All right, here's something exciting, huh? What's cash? Cash. Currency, coins. deposits, customer checks, cashier's checks, certified checks, money orders, wire transfers, direct deposits, and credit cards. Credit cards are cash. So those are big components of cash. But for accounting purposes, short-term, highly liquid investments that are readily convertible in roughly 30 days, we count that as cash as well. Cash management. We want to encourage prompt payment. We want to take time, make it paying our own bills, etc. Some internal controls. Here we go. This person rings up the cash sales on the register and prepares the report. It goes to somebody in this department and they count the money. And then it goes to this department, they count the money again. And it goes to this guy who maybe enters it in this, etc. The more people involved in the process, the better. And you're going to make mistakes on a cash register or petty cash. So here, cash register shows that the tape says we sold $550 worth of meals today, but the count of cash is $555. We made $5 somehow. And that can happen. Maybe we accidentally shortchanged the customer or didn't record something. It happens. If it's a loss, it just goes the other way. It goes into the account called cash over and short. Cash receipts by mail. Blah, 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 blah. Just read through these things. Not with the idea of memorizing anything, but good common sense bullets that you can have in your head for answering some of these. I'm not going to go into a voucher system. Petty cash. Petty cash. Set up for small little things, huh? Petty cash. We set it up with a debit to petty cash, credit cash. So you now have two cash accounts on your records. And then during the month, we had all of this activity. We had some tile cleaning done. We bought some merchandise. There was a COD for $5. We sent some money running down to Office Depot to get some adding machine, whatever. The total comes to $71.30. We record that $71.30 at the end of the month. This is the journal entry to reimburse petty cash. Debit the expense or whatever it is, total $71.30. And we send the custodian to the bank and cash that check. Sometimes you want to increase the petty cash or decrease it. You debit petty cash or you credit it. It's pretty obvious. Otherwise, you never debit or credit petty cash. Once you set it up, you never touch it unless you do this. You increase it or decrease. Cash over and short, huh? Petty cash was off by $7. Short. Oh, my goodness. Oh, my goodness. Bank things. We know what a deposit ticket is. We know what a check is. The bank statement, let's look at that briefly. The bank statement will always show you on top a summarized look. Beginning balance, checks that came out, deposits that came in to a new ending balance. Now, here we go. Bank reconciliation. I can demonstrate this, all night, but until you start doing a few of them and get the feel of it, they might be maybe a little tricky. I'll try to make this a little bit easier. This is a very good printout. Look at this slide. We have a bank side and a general ledger side. We're going to take the cash balance per the bank, cash balance per the general ledger. On the bank side, all you have to do is add deposits in transit, subtract outstanding checks, and you're done. We're not going to worry about bank errors. Bank don't make errors. Simple as that. Balance per bank plus deposits in transit minus outstanding checks gives you what is called the adjusted cash balance or adjusted bank balance, okay? No journal entries here because we're telling the bank something they don't know. Now we're looking at the bank statement and the bank is telling us things we don't know. Well, we opened up the statement and we found out one of our customers paid us not with a check, but with a direct deposit. Okay, well, that's good to know. The bank is telling us now. There was some interest revenue too. We had interest income, but we also had some bank fees, an NSF check, non-sufficient fund check bounced, and book errors. And yes, here we have errors. We're the ones who make the errors. So we're going to need journal entries to record all of this information we're learning for the first time from the bank statement. And look at this reconciliation. I might suggest, if you're going to do a bank rec problem, don't even look at the numbers at first. At first, put down the bank statement, add deposits in transit, less outstanding checks, adjusted bank balance, and you're done. And you are done. Here we go. Remember, on the bank side, it's easy. Bank balance plus deposits in transit minus outstanding check, 1845. Here, it's a little different. You've got a book balance to start with, and we look at the bank statement, and we see a customer paid. We earned interest. The bank charged us $23 to print checks, and we had a bounce check, an NSF check, okay? I think we have the same screen here. I didn't get a chance to talk about this. Let's understand the terms. What is a deposit in transit? In transit means something on its way to someplace else. Train on the track is in transit. A deposit in transit is a check written by our customers that we deposited. We deposit customer checks. Outstanding checks are checks we wrote that haven't cleared the bank yet. So understand that. Pretty easy to understand. Deposits in transit, outstanding checks. Now here we know we have to write journal entries because our book balance is wrong. We collected a note, we had interest, we had a check printing charge, and a NSF check. Let's look at the journal entries. Well, we found out that somebody direct deposited $485. We get the debit cash, in this case, credit notes receivable. If it was a customer, we would have credited accounts receivable. Hey, we found out we had interest in income of $8. We debit cash, credit interest revenue. Remember, they nicked us $23 for check printing. There you go. There's the expense. I don't think you would have miscellaneous expense. You'd probably call that bank fees. And here's the one I want you to really concentrate on. Remember, we had a bounce check from a customer, NSF check, non-sufficient funds. One of our customers wrote us a check for $30. We deposited it, forgot about it. and then learned to our annoyance at month end that the check was no good. The guy had no money. Tiger Woods here had no money. So when we received the check, we probably debited cash, right? And credited accounts receivable. Now we're just putting them back up. So now he owes us the money again, and we can go after him. Okay. I hope they put some metrics on your test. Okay. Again, we're talking turnover. Before we took the cost of goods sold divided by the average inventory. Here, we're taking the net sales divided by the average AR. And then we divide that into 365. 22,000. Oh, they're not, I see, they're not showing the days. They're showing the turnover. They're skipping a step here. If you took out your calculator and you divided 22,387 by 870, and then divided that into 365, you would get the 14 2 days. But more importantly, what does this metric tell us? It tells us how quickly our customers pay us. Okay? Starbucks gets paid in 14 days. Jack in the Box in 16. It takes Starbucks 14 days to collect from a customer on average. And may I say, that is spectacular if you can do it. So remember we had the cost of goods sold number before? And I guess I don't recall what the days were. But let's say I think the days were 32 now that I think about it. So we had 32 days when we measured the cost of sales against the inventory. That meant it takes 32 days from the time we buy the product until we sell it. Now we learned it takes another 14 days to collect. So 32 and 14 tells us from the time we buy something to the time we sell it in cash, 46 days. I don't know if I think I covered this briefly. I'll do it again. In the world of purchasing, if you work for a fairly large company, you can't go out and buy your own stuff. You can't be sitting at your desk and you decide your computer is obsolete and walk down to the store and buy a computer. No, it doesn't work that way. You have to request it, requisition it, purchase requisition. That's just a form. I just want to see what they do here. Purchase requisition is just that. You hand it to your boss, and it's a form, and you say you need a new computer. That's it. It can be very generic. He approves it. It goes over to the purchasing department. You want all the purchasing done in one area. The purchasing people know where to get the best deal. They order it. Computer arrives, there's an invoice. The people downstairs in your factory or store, they're going to record what you received on a receiving report, match them all together, staple them up, and you're ready to go. Anyway, that's the end of chapter 6. How we doing out there? Questions? No? Okay. Okay. This concludes our review. Anybody want to hang around and talk about the FSA?
I do.
And Kel do.
And Kel do.
Okay. Marcel, you going to join us or you taking off?
Oh, I think I'm fine. Thank you.
Okay. All right. Let's talk about it. Let's see what I can do for you here. Hold on. let's see if I can bring up the sample. Well,
Yeah, it populates now.
You're gonna be busy, huh?
Yeah.
Okay, I think I have it. Okay, this is beautiful, huh?
Yeah, mine doesn't look like. I got a separate file for each company. I got a bunch of bullet points for General Mills I finished today, and now I got to go into narrative formula.
Yeah. Okay, everybody see it?
Mm-hmm.
Okay. First thing, I need a 1 minute break. Okay, I'll be right back. So take a look at this while I've come back.
Welcome back. I think it's just us now.
What's that?
I think it's just us again.
Okay. Just me and you?
Yeah.
Okay. All right. Well, you should be pretty good with this first page, right? We went over this. You
Yeah,
get
it doesn't quite look as polished as this, but yeah.
Yeah, it doesn't have to look as polished as long as it's the same format. Yeah. Cost of sales divided by 2118 equals that. And notice that everything adds down. And you remember how to get these numbers. So I think you're okay on this part here I'm highlighting.
Yeah. My issue's on the write up.
What's that?
My issue's on the write up.
Okay. Okay. All right. Let's assume these numbers are good. I have no idea if these numbers make sense or not. But let's take a look. Okay. You have two companies. Wow. These companies are a poor match, it looks to me. One is 3 times bigger than the other, huh? In sales. Okay.
That's a good observation to start with.
Yeah. The smaller one
Coca-Cola.
is more profitable. It really isn't. These are made up numbers.
Mm.
Yeah. Okay. So the first thing you might notice, you could start your FSA by saying Pepsi Cola with sales of $2 billion is twice as big as Coca Cola. Okay. And then you say, but Coca Cola has considerably higher net income than does Pepsi Cola. Okay. and you might say, let's look at the cost of sales percentages. Those are very similar, huh? Wow, they're almost the same. So that doesn't mean that's not going to do us much good. The gross profit is 45, 43. So there's nothing there. But look at the operating expenses. Look at Pepsi-Cola's to 37% to 27, 39 to 30. Say something about that. Pepsi-Cola's sales triple those of Coca-Cola, yet Coca-Cola is showing improved, better net income on a percentage basis. The problem seems to be in the operating expenses, where Pepsi-Cola's are 10 points higher. And then go into the financial statement, do a little bit of reading. Google in their operating expenses, or look for the operating, and they'll probably have some comments on them. Okay. Pepsi-Cola probably does a hell of a lot more advertising, would be my guess, than Coca-Cola. Pepsi-Cola has a huge stake in snack foods. When you buy Lay's potato chips, that is a Pepsi-Cola company. So when you go in there, you say something like, Pepsi-Cola is 3 times larger and the net incomes are diverse. Pepsi is a major bottler of soda and some other things. At one time, they owned Pizza Hut. I don't know if they still, that type of thing. They make a little bit of sense?
Yeah, they still do own Pizza Hut. You can only get pizza. You can only get Pepsi-Cola Pizza Hut. You can't get Coca-Cola.
Yeah, there's no Pizza Hut in town. And then if you want to talk about the time series, let's look at net income. Net income.
Mm-hmm. It's almost Pepsi-Cola is almost as big as Coca-Cola.
Yeah. Okay, hold on. Yeah. That's interesting, isn't it? Again, I keep forgetting these numbers are made up, but for purposes of the write-up, it's the same thing. Look at this. This company, we'll call it Pepsi-Cola, they had almost a tripling of their net income from 21 to 22. That heck could that be? They sold 700 million more, and they brought their operating expenses down. Actually, so anyway, you can make some comparisons like that.
I have a question though. The average receivables.
Yeah.
Okay. I don't see receivables on the form. I'm guessing those are pulled directly from the statements.
The average receivables, you get that right from the balance sheet.
Okay. So then we take 2022 plus 2021, divide that by 2.
Yep.
And that's our denominator. Okay.
That is the denominator, correct.
Okay. Okay. Okay.
So they that get you going then?
Yeah. Fortunately, I got to go to work, so I can't do it right now. I'd love to just crank it out now and be done with it.
Yeah.
But I'll do what I can over the weekend.
Yeah. Then let me see it. We'll work on it. Okay.
Appreciate it. I'll be contacting you tomorrow morning because that's when I'll be working on it again.
What's that?
I'll be contacting you tomorrow morning because I'm working on it tomorrow morning again.
Tomorrow.
Yeah, like all we have left is the weekend. Tomorrow and Sunday.
Yeah. Okay, what time tomorrow?
Because 9 o'clock my time work.
Pardon me?
9 o'clock my time work.
How about 10 o'clock? Is that good for you?
Perfect. That works.
Okay. Yeah, I have to get out of here about 11:30 tomorrow. That's why I'm hesitating. Okay. Let's do it. Talk to you 10 o'clock tomorrow, okay?
Thank you, Bob.
I'll see you then.
Bye-bye.